Hey everyone, thank you for tuning in for this video on our series for partnerships. My name is Dr. Brian Winter. I'm a tax attorney and tax professor. And what I'm going to be talking about today is going to be our tax year for a partnership. So when we have a partnership, we have to worry about our required tax year, which is different than a C corporation where we can generally just select a fiscal year or a calendar year. So in this video, what I'll do is I'll talk about the three tests in order to determine our required tax year. It's going to be our majority partner rule, our principal partners, and then our least aggregate deferral. And then after that, what I'll do is I'll talk about a couple exceptions that apply to where even if you have a required tax year, you may be able to adopt a different tax year than your required tax year. And in the process, I'm going to be talking about some different examples. I'll walk you through the process so you should be okay when you see this on either your in-class exams, your EA exams, or your CPA exam. So let's go ahead and let's get to it. Okay, so let's talk about these required tax years for our partnership. So our partnership, to figure out the required tax year, there are three tests, and we have to go in order of these tests. So the first test we have to look at is majority ownership. The second test is the principal partners, and the third test is the least aggregate deferral. Now that's going to tell us what our required tax year is. Sometimes our partnership wants to adopt a tax year that's outside their required tax year. They may be able to do it. So you can see the exceptions to the required tax year over here with Section 444 election or a natural business tax year or a business purpose year. I'll talk about all of these throughout this recording. So what you're going to see is I have some examples that will work through the three required tax years, and then I have an example for each of the exceptions, which will be later in this presentation. But let's just briefly talk about the required tax year and what this even means. So when we are looking at the required tax year, the first thing we look at is majority ownership. What is majority ownership? Well, we're looking to see if whether a single partner or a group of partners that have at least 51% control of the partnership share the same tax year. So if we only had two partners and we say partner A is has a calendar year tax year and they own 51% of our partnership, and then partner B has a June 30th tax year, but they only own 49%. Well, we do have a majority ownership. We have partner A who owns 51% of our partnership. Because of that, we're going to adopt the calendar year tax year that partner A has. Now, it's not always as easy as one partner has more than 50% shares. What often happens is you're going to have a number of partners, and we're going to determine whether they have ownership of at least of over 50%, right? So, for example, we could have 100 partners, and each partner owns one share, well, or 1% of the partnership. Well, if what happens is 51 of those partners have at least 51 of those partners have the same tax year, then that'll be the tax year we adopt because out of the 100 partners, we have over 50% that have the same tax year. So if you had 51 taxpayers that had a June 30th tax year, then we would adopt a June 30th tax year. Okay, because we have over 50%. So that's the majority ownership. The second one is going to be the principal partners, and a principal partner is defined as any partner that owns at least 5% of the partnership. Okay, so if you own 1%, 3%, 4%, hey, you're not going to be a principal partner. If you own 5%, 7%, 19%, 28%, whatever it is, now you're a principal partner. And what we're dealing with on the principal partner test is do all of our principal partners, those that own at least 5%, have the same tax year? Every single one of them have to have the same tax year. Now, when we add those up, it's going to be below 50%, or below 51% anyways, because we failed the majority ownership rule, because that's the only way we get to the principal partner rule, is if we fail the majority one. So when we get over to the principal partner one, it's going to be less than 51%. It could be 28%, and that could be enough because we didn't meet the majority ownership with all of our partners. No group had at least 51% with the same tax year. So then we go to the principal partners, and then with all those principal partners, we look to see, okay, do these principal partners all share the same tax year? If yes, that's where we adopt the tax year. However, if we have one principal partner that has an odd tax year that doesn't match up with the other taxpayer's tax year, then we fail test two. We have to go to test three, which is the least aggregate deferral. And what we're trying to do in that one is to minimize the deferral amount. So here's what's going to happen. On the next portion of this video, I'm going to walk you through examples and I'm going to give you additional context to each of the required tax years for the majority ownership, principal partners, and lease aggregate deferral, so you can see how the rule applies when we use it and see the computations to make sure you're able to solve those. After we do that, what I'll do is I will summarize the exceptions to the required tax year, and then I'll give you an example of those three different exceptions to the required tax year. So let's go ahead and let's jump over to our majority ownership problem to see if we can get this down. All right, so let's take a look at our first problem. And what we're focused on here is going to be, do we have a majority shareholder rule? So remember, when we're talking about the majority shareholder rule, what we're saying is there at least 51, so it's more than 50, at least 51% of our partners that have the same tax year? Okay, they have the same tax year. Now, it doesn't mean one individual partner has to have the same tax year. We're looking to see if over 50% of all partners have the same tax year. So technically, if you have 100 partners and you have 51 of those partners have a calendar year tax year, then yeah, we're going to have the majority rule. That's going to be our tax year. It's a calendar year because we had over 50% that share that same tax year. So let's take a look at it. We have Buckeye Partnership is formed by three Ohio State students. Ryan owns 45% and uses a calendar year ending December 31st. Carmen owns 25% and also uses a calendar year ending December 1st. And Brutus has remaining 30% and uses a fiscal year ending June 30th. All right, so we have two different dates that we're looking at. Buckeye Partnership must determine its required tax year under the majority interest test of section 706. And here's what we're doing, right? So we're looking at our three partners over here and we're saying, well, what is their tax year? So we have a December 31st tax year. Okay, we saw that up here, that we had somebody who had a tax year of December 31st, and we have somebody who has a tax year of June 30th. So let's just see what percentage is under each of our tax years. Well, for December 31st, we had 45% for Ryan, okay, and then Carmen owns 25%. All right. So they're both using that December 31st. So 45 and 25. So if we add these together, we're at 70%. Hey, I can tell you right now, that's over 50%, right? So we have to have December 31st, a calendar year tax year. Now, when we look over here at June 30th, we said, well, that was Brutus, and Brutus has 30%. Okay, fine. It's still, we have a majority tax year, so we're going to go with December 31st. So that is going to be our answer for this problem. All right, well, let's go ahead now and let's take a look to where maybe the majority doesn't apply. So let's look at the principal test and see if we can figure that out. So let's take a look at our second example here. Okay, so what we're looking at here is a situation where we have 28 partners in the college crew partnership. And we need to go ahead and figure out what the tax year is. Now, of course, the first step we always have to do is we have to figure out, does the majority is there a majority that owns this partnership? Because if the majority has the same tax year, we need to go with that tax year. So what we have to do is we have to look at all these 1231s and then all these 1031s, and there's some June 30s in here. So we have to add up the percentage for like all the 1231s, right? So we have all the different partners here, Otto, Abby, Herbie, whatever it is. We have our 4% on December 31st, 3% December 31st, 4% December 31st. So we add all these percentages together to see if we have over 50% that share the same tax year. Well, I already did the math for you. And if my math is right, we have 47% that have a December 31st, a calendar year tax year. We have 33% that had the June 30th tax year. and we had 20% that have the October 31st tax year. So looking at that, we were close. We were close to a calendar year, but that didn't hit over 50%. So the first test failed. Now we go to our second test, and now all we're doing is we're looking for principal partners. We need to find principal partners. Remember, a principal partner is any individual who owns at least 5% of the partnership. So it could be well over 5%, but they have to have a minimum of 5%. So what we're going to do now is we're going to disregard every other partner that is below 5%. So we need to come through here and we need to say, okay, where are they? Well, we've got Lobo. Okay, Lobo has 5%. So we need to worry about Lobo. Their tax year is June 30th. Now, as we're going through it and we're looking at these principal partners that have that 5%, we're trying to see if every single one of those partners share the same tax year, right? If Lobo had, say, December 31st and everybody else had June 30th, hey, then we fail this test as well, right? Because not every single principal partner had the same tax year. But let's see where we're at on this one. We have Lobo 5% June 30th. Okay, so I know we have to have June 30th. So for every other principal partner, I better have a June 30th or I fail. Let's see. Big Al 9% June 30th. Okay, so far so good. Joe, nope. Cosmo, nope. Bruiser, Sparty. Reb here, 7%. All right, June 30th. So far we're good. Let's see if we have any others. Bevo, June 30th. We work here. It all comes down to Hooter, 7%, June 30th. Boom. Second rule applies. The principal partner applies here, right? Because no majority ownership greater than 50%, we check for principal partners. Principal partners, at least 5% ownership includes, and those are the five that we just went through, or six, I guess it is, five, six, whatever it is. Um, they all have June 30th. So our partner must now adopt a June 30th tax year. So that's our required tax year. Now we're going to see here in a bit that there's ways to get around the required tax year. There's a couple limited exceptions, but what we're focused on right now is our required tax year. Now let's look at one more example because we need to look at a situation to where maybe it fails under the first two, and we need to now figure out what happens with the least aggregate deferral so you can solve that type of problem. Okay, so let's look at the third example. This one's going to be our least aggregate deferral. So remember, we don't use this test until we've already gone through the majority partner and the principal partner tests. So this is our third test. Now, here's our example. Renegade and Big Al form Crimson and Gold partnership as equal owners, so they're both 50%, with the objective of selling sports memorabilia. Renegade has a calendar year tax year, and Big Al has a September 30th tax year. Okay, what tax year will apply? So we can look at it right away. So is there anybody who has over 50%? The answer is no, right? There's no majority taxpayer, tax owner with their tax year because they have two different tax years and they both each only own 50%, none of them more than 50%. So we fail the first test. So then we go to the second test. We say principal partners, do they all have the same year? Well, no, because again, there's only two. One of them's a calendar year, one of them's September 30th. So they're not the same tax year. So we fail the second test, which brings us to our third and final test, which is the least aggregate deferral. Now, in this one, what is happening is the IRS is trying to minimize how much deferral from when the partnership tax year ends until a partner is going to be recognizing it on their own tax return. So you want to minimize that number. So let's go ahead and take a look at what happens. Now, when we do the least aggregate deferral, what we're dealing with is we're saying, hey, let's play make pretend. All right. We're playing make pretend, make believe here. We're going to play make believe. Now, what we're going to do is we're going to say, let's pretend as though the partnership adopts the tax year of who do we have for the December 31st one? We're going to say that that's Renegade. Okay, we're going to adopt Renegade's tax year. So what happens if the partnership adopts Renegade's tax year? Well, we put the partner here, Renegade. Renegade owns their percentage is 50%. The partner's tax year is December 31st. Well, if the partnership and Renegade both have December 31st, There's no months of deferral. What happens is when the partnership ends, Renegade's reporting their taxes, so that they're the exact same. So there's no problem with that. So we're going to go ahead and we take this amount, our 50% ownership, times the months of deferral, and that gives us an aggregate of 0 months. Okay? So then we have to do the same thing with Big Al. So now with Big Al, what we're doing is we're saying, okay, we're saying that the partnership adopted the December 31st tax year, but Big Al's tax year isn't until September 31st or September 30th, right? So we have a September 30th here. So if this were to happen, look what would happen. So Big Al owns 50%. So we would go, if the tax year ended December 31st, how long until Big Al is going to report the income from the partnership? Well, we've got all of January, February, March, April, May, June, July, August, September, 9 months, 9 months until Big Al has to report that income. Well, what we do is we take that 9 months, and you can see here's our formula. We take the 50% ownership that Big Al has times our 9 months, and that comes out to 4.5. So there's 4.5. So we add those together and we have a total aggregate deferral of 4.5. Now, in this test, what we're trying to do is we're trying to get the least aggregate deferral. So we now know what happens if the partnership adopts a December 31st tax year. What we need to go do now is we need to go look at the partnership. What happens if the partnership adopts a September 30th tax year? What if they adopt Big Al's tax year of September 30th, right? So Big Al's tax year of September 30th. What is going to be our aggregate amount of deferral here? So what we're going to do is we're going to say, okay, well, Renegade, you have 50% here, ownership still. Your tax year is until December 31st. So if the partnership's tax year ends on September 30th, you're not going to report your income until October, November, December. 3 months. 3 months. So we have 3 months of deferral. And we're using the same numbers like that I used up here, right? We're taking 50%. So that's our 50% over here. And we're taking our 3 months of deferral. Our 3 months of deferral is right over here. So we go 50.50 times 3 comes out to 1.5 months of deferral. All right, now what we have to do is we have to say, okay, if we adopted the September 30th, how much deferral does Big Al have? Well, that's going to be zero because look at, if we adopt the September 30th, that is Big Al's tax year. So we're pretending as though we adopted Big Al's tax year, just like we did when we had Renegade on December 30th and December 30th. There was no deferral there. So we go 50% times zero equals zero, which means that we have 1.5 months of deferral. Okay, 1.5 months of deferral. So we're going to take the lower of our 4.5 and our 1.5, and that's going to be our required tax year under the least aggregate deferral technique. So here we have 1.5. That is our new tax year. That's our required tax year. So that's what we're going with. Now, you don't have to have just two partners. We could have done this with three or four or whatever, but the same process is going to happen. What's going to change is maybe a different tax year here, and you're going to have different ownership, but it's still the same process. If you can do two, you can do three. If you can do three, you can do four. So I'm not going to go into any more complex ones to keep this to a reasonable length, but that is a process that you're going to use. Now, that is how you determine your tax year, your required tax year. But as I mentioned in the introduction, sometimes there are exceptions where we can get away from using a required tax year, such as a natural business year and for a seasonal business or a business purpose, right? And what I'm going to do is I'm going to give you a couple examples to where you can see an exception that applies to our required tax year, and usually restricted on how much deferral you can have, like 3 months or whatever. But we'll look through those different tests here shortly and make sure you're able to navigate those in case you see them on your CPA exam or whatever. All right, well, let's go ahead and do that then. Okay, so let's look at the exceptions. Now that we know what the three tests are to figure out our required tax year, sometimes a partnership doesn't want to actually adopt that and they like to do a different tax year. And there's different reasons they may want it, maybe more of a natural tax, business tax year, like they're seasonal or something. But whatever the reason, they want to take on a different tax year. So here's the three primary exceptions that you can look at. The first one's going to be what we call a 444 election, okay, because it's coming from section 444. And what it says is we can take a partnership tax year other than our required tax year as long as the new tax year is within 3 months of our required tax year. So if our required tax year was, say, December 31st, we're a calendar year, we could do an October 31st because that would give us, right, if we took that, our 3 months deferral would be all of November, all of December, right? So we would have within 3 months of the required tax year, we're doing a deferral. Now, here's the thing. There's some requirements that we have to do. We have to file a form to be able to do this. And what we do is we make the election with Form 8716. So there's a form that we have to complete, and then there's actually an annual payment that we have to make. And I'll walk you through an example that deals with these annual payments. But what it's doing is it's basically saying that, hey, we're going to pay an amount that is equal to the deferred taxes that we otherwise would have paid. And this is done annually and it's going to be adjusted annually. It's not a tax and it is refundable once the 444 election is no longer used. But what the IRS is basically doing is they're saying, look, if we gave you a 3 month deferral and we're saying that you can take an October 31st tax year but your required tax year should have been in December. That's 2 months from when your partnership ended until your partners are going to be reporting that income. And because of that, it's like a tax-free loan to them. So we want to make sure that you're not using this as a strategic mechanism in order to defer gain recognition. So what we're going to do is we're going to go ahead and we're going to have you make this payment and we're going to hold that payment and we're going to capitalize on the time value of money and we'll eventually pay this back to you in the future. But that helps eliminate any advantage from tax deferral that you otherwise would have received. So they're trying to make sure there's a legit reason and it's not just a business, it's not just a tax strategy technique. Okay, and I'm going to walk you through some problems with each of these, so we'll see how this works out. The 444 election is probably the most challenging of the three as far as understanding computations with it. So let's look at the second one, a natural business tax year. So sometimes you're a seasonable business, like let's say that you're doing something that deals with operating a ski resort or something like that. Well, you know when your tax year is going to end because it's seasonal. You might be going until February, depends on your location, maybe even March. Um, but then it ends at that point. So even though your taxpayers may have required you because of their, the principal partners or the majority or whatever it is, may have required you to adopt a calendar year. You may say, yeah, but look my business really ends in March because my sales are really occurring within this one period of time. Or maybe you're selling Christmas supplies and you know that right after December, whatever the case may be, you have a natural business tax year. And what they want to know is if you have, right, at least 25% of your gross receipts occurring in the last 2 months of the year of what your new tax year would be, then you can adopt a natural business tax year. Okay. So you have to apply this 25% test using the past 3 years of receipts. Now, you don't need any IRS permission to do it. There's no special forms. You're able to do this without all those other requirements. So if there's a natural business tax year, then yeah, that's a legit purpose. It's not for tax deferral purposes, and we're going to be able to do that. We just have to show that 25% of gross receipts tax. Again, 25% of gross receipts. I will go ahead and I will walk you through an example with that as well. And the third one is a more challenging one to do. This is a business purpose tax year. So we want to adopt a different tax year because we have a substantial business purpose. Now, this is different because we're not just using these formulas of 3 months deferral or 25% gross receipts. Instead, we have a business purpose that we want to use, and we are going to have to demonstrate that business purpose. And what has to happen is we request a ruling from the IRS to say, yeah, we're going to let you do that. So we've got to pay for this ruling. So that would be the approach to do the business purpose tax year. All right. So let's go ahead and let's look at some of these problems so we can do a problem for each of these to make sure you're comfortable with this material. So let's get to it. So the first example that we're using is that 444 election, right? So we know we can't have more than 3 months of deferral. So this is the most complicated one. We're going to walk through it. I used a revised group of the revised facts from our least aggregate deferral. You can jump back to see those if you would like. Otherwise, I'm going to give you enough facts with this, so it shouldn't be a big issue for you. But this one was dealing with the Crimson and Gold partnership. All right. So, and then when we were looking at the least aggregate deferral, of course, we are dealing with Renegade and Big Owl, if that helps. Okay, so anyway, let's take a look at this. So you can see under the facts, I put same as least aggregate deferral, but assume the required tax year is September 30th, but they want a 12/31 tax year. Before, remember, we had a 12/31 tax year, but that wouldn't work because we're from 12/31 to 9/30. That would have been 9 months of deferral, and we're not looking at 9 months of deferral. We can't do that much under this rule. So I'm saying that pretend like our actual required tax year was going to be September 30th, but they want to go ahead and they want to adopt a tax year of 12/31. So the first thing we have to say is, hey, is this within 3 months? Right? So if we went September 30th, so we have all of October, all of November, all of December. Yep, 3 months. We're good there. We're good. So we can keep moving forward on this. So to do it, what we need to do is we need to do our 444 election, which means we have to file the form 8716. And then what we're going to have to do is we have to pay a required payment. All right. So let's look at how this works. Now, as we come down here, we can say, here's the details. During the year, we're saying the partnership had taxable income of $300,000. Now, what we pay taxes on for each of our owners, so Big Al and Renegade, is going to be their distributive share. Well, their distributive share is their portion of the taxable income because we know our partnership does not pay taxes. And if this stuff isn't making sense, please go back to the earlier partnership videos to kind of go through this process so you understand what distributive share is and how they're taxed. But anyways, we're saying that they had $300,000. They're both 50% partners. So because of that, what we have is $150,000 each, right? So we have $150,000 each, which is their 50% share of their distributive of the taxable income. So their distributive share is 50%, which gives us $150,000 each. Great. That's what they're taxed on. We know that. All right. Well, let's keep looking through here. Okay. So now that we know how much distributive share is, what we can do is we can now calculate, based on their taxable income, how much their required payment is. So here's how we calculate our required payment. We take the deferred income times the deferral fraction times the highest individual tax rate. So today, our highest individual tax rate is at the 37% bracket. So you're going to be using 37%. Now that can change over time. So if you're watching this and the tax rates have changed and it's no longer 37% as a maximum individual tax bracket, then that could be a different amount. So you follow that amount. But we're at 37%. So what's going to happen is we're saying, okay, the partnership taxable income is going to be $300,000 times the deferral refraction, which is going to be 3/12 of that 100,000. Why? Because they're going to be taxed on this $300,000, right? They're going to be taxed on the 300,000, but they're not going to pay taxes because they've deferred it for 3 months. They're not, so the partnership tax year ended in September 30th. Our partners aren't paying taxes on October, November till December. So there's 3 months of deferral. So of that $300,000 that we have, okay, our taxable income up here, what we're doing is we're multiplying it by 3/12, which equals $75,000. All right, you see that? We're at $75,000. Well, what we have to now do is we have to worry about the tax rate, right? So we go 75,000 times where we said our highest individual tax rate was 37%. Okay. We said it was 37%. So we're taking that 37% and we're bringing it all the way down here. Okay. And the 75,000 came from our deferral of 3 months. Now, if we said we were accepting or using a October, let's see, our required tax year was October 31st, and we wanted to push it till December 31st, we wouldn't have used 3/12, we would have used 2/12, right? Because we're only going to be deferring it for all of November and December, 2 months. But here's why we have 3/12, which is why we used the three, because we're doing 3 months of deferral. Okay, so that's the months of deferral that you're looking at. It cannot be four. It can never be greater than three because this is a max. On a 444, three is the max. All right, so we took that $75,000, which was 3/12 of our 300,000, and we're multiplying it by the maximum tax rate. So our required payment is $27,750 that we have to pay to the IRS under the 444 election. Now, we will eventually get that refunded when we're no longer using a 444 election. That could be 10, 12, 15, 20 years down the road. Just depends when we're not going to use it anymore. And what has to happen is this is going to be per year. Now, it doesn't mean that we're paying $27,750 per year. What it means is we have to go through this formula every single year. Okay. We're doing these calculations every single year. But let's say that next year, when we go through these calculations, this comes out to $30,000. Okay. It's 30 grand. Well, guess what? Now we only have 27,750 in it. All we're going to put in is an additional $2,250 so we get to that 30 grand. Okay, so we don't put in a full new 27,750. We just increase it a little bit to where we're making sure that the amount that the IRS has deposited is going to be withheld is equal to this formula. Now let's say instead of 30,000, it came out to $25,000. Oh, okay, we only needed 25, but instead we put 27,750. We've paid 2,750 too much. So we're going to get a refund of 2,750 because we only need to keep 25,000 in it for this year. And then next year we'll do the same thing. We may have to increase it or we may decrease it, but that's what's going to happen. And the way that this is helping the IRS is they're getting to capitalize on time value of money. So when they eventually pay this all back in X amount of years, it's not as valuable as it was when they first took that money. This also disincentivizes using this election for tax planning purposes. Okay. Um, One more thing I want to talk to you about over here. Okay. So they're making this payment. Now, it's important to note that this payment, it's not a tax, it's not an expense, it's nothing like that. So what happens is it's not going to show up on our K1. And what it doesn't, and it's important to note, it is not going to go ahead, um, and it's not going to reduce our distributive share. Look at, they still have to pay their taxes on 150, even though our partnership had to pay $2,750, $27,750. It didn't reduce our distributive share. It's not an expense. So our partners are still paying on their full distributive share. And this isn't a deductible amount or anything else like that. It's just a payment that was put in there. It's not deductible, it's separate. So you can see is not deducted. So distributed shares stays the same and it does not appear on the K1 because this is eventually going to be refunded to them. All right. So take some time, work through this problem. It's a little bit complicated, but the 444 election is fairly common. It's that payment portion that you have to be able to do that formula and be able to calculate those formulas. All right, so let's go ahead and now let's look at more of a natural business tax here and see how that approach is going to work so you're ready for that when you see it on any of your exams. Okay, so let's look at the natural business year. So what we're looking at is, do they have that natural business year to where at least 25% of their sales are coming from the final couple months, right? So here's what's going to happen. So we have our natural business here. We're looking at 25% of gross receipts test. So we have to be able to apply that. So how much of their gross receipts occurred in the last 2 months of their tax year? So that you have a required tax year, but they're saying, listen, maybe my required tax year is June 30th. They're saying, but come on, I only sell Christmas decorations. My year end is December 31st. I mean, that's what I would like because that's kind of when my tax year ends. Maybe I'll go until January 31st because that seems to make sense. You know, I'm clearancing stuff, whatever. So you want to adopt a different tax year than your required tax year. Well, let's see if we can do this. Okay. So, Crimson Season Rentals operates a winter ski lodge. Revenue patterns are as follows. So, November, they have 15% of their annual receipts, and in December, they have 20% of their annual receipts. Well, let's just add those up. So, if we add this up, that's going to equal 35%, right? We have 35% right there. So, 35% of their gross receipts occurred in the final 2 months of what they want for their tax year. So they're trying to adopt a tax year for 12/31 instead of whatever their tax year may have been, like a June 30th or whatever. So they can do this because that 35% is greater than our 25%. Okay. Now, had this only come out to 20%, so let's say that we had 15% and 10%, so it comes out to 25%. Well, okay, let me just go. I wanted to do 20% for you. Let's say this is 10% and 10%, that comes out to 20%, then we fail right here. Okay, so 25% fine. It's just if we are below that, then we have to stay with our natural tax year, or we have to see if one of the other rules apply for the exceptions, like the one we just did, the 444 election, or a business purpose, okay, which is a little bit harder to do. But you can see since 35 cents greater, the Crimson season rental passes for natural business year test. So it passes. So we're good with that. Even if the required tax year is something else, they may adopt a December 31st tax year. Notice that this isn't the requirement that it's within the 3 months, right, of our required tax year. That's where it differs from the 444 election in some regards. But the 444 election didn't require 25% of gross receipts. Okay, so there are some differences on it. And then with this natural business tax year, we aren't paying the deferral amount up front on that. So this is the rules that we're looking at for the second test in natural business year. Let's look at one more exception, and that's going to be our business purpose year. And after that, we'll wrap it up, and you should be good with your tax years as you prepare for these exams. Okay, so when we're looking at the business purpose year, here's the thing. What we're looking at is it's not satisfying maybe the 444 election because maybe it's not within the 3 months, and maybe we don't have 25% of the sales, so we can't sit there and say it's a natural business tax year, but there might be a legit reason we want to have a year other than our required tax year. Because remember, with all the exceptions, we have a required tax year and we wanted to deviate from that required tax year. So here we have Garnett Productions Partnership creates an annual TV series from July to June. All filming, editing, and budgeting cycles flow from July 1st to June 30th production year. The required tax year under the three-step test is December 31st. So what they mean by that is perhaps what we did is we went ahead and we said that um, under the majority taxpayer rule, a majority of them had December 31st, or principal partner rule, or the least aggregate deferral, whatever it was that said December 31st. But because we're going from July 1st to June 30th in our current business here, we don't want to adopt that required tax year. Okay, so what we can do is we can we have to request permission from the IRS on this. We have to get a letter ruling from the IRS that gives us permission to be able to adopt a business purpose tax year. So we're going to file Form 1128. We're going to pay for this ruling, and we're going to say, hey, look at because of industry practices, our production cycle alignment, administrative benefits, we're going to have to make our case for the IRS to grant us permission to adopt a business purpose year. So the IRS is going to make a decision as to whether we can adopt the specific year. And if they approve it, then we can now adopt our June 30th tax year. If they don't approve it, then we're going to stay with our required tax year. Or we need to just say, okay, do we have maybe we can do a 3 month deferral or whatever it is going to be, 3 months from our required tax or whatever the case may be. You'd have to look at one of the other exceptions at that point. All right, y'all. This is the end of this recording. If this has been helpful, please make sure you subscribe to my channel because I'm going to continue to be giving additional videos on all things business tax, and I'll eventually move over to individual tax as well.